Hi everyone, Bowen from Enhanced Asset Management here. Just back with a quick update today to run through Zip's third quarter results and also to talk through the way we're positioning portfolios at the moment, given everything that's going on within the Middle East and how that's looking like it's playing out at the moment. So we'll just start today with Zip's results. So they updated the market on Friday and the results were really strong. So I've just outlined a few on screen here. So it was a record level of cash EBITDA for Zip, and that was up around 42% for the quarter. And we saw some good margin expansion come through as well. We spoke about that February result, which we didn't think was too bad. There was a few little key metrics in there that the market didn't like, and we saw that one sell off pretty hard. And the key metric there was the net bad debts. So we can see in the third quarter they've ticked up to 1.9% of TTV, and that's up from 1.6% back in the third quarter of 25. And this is still in line with management targets. And it has also included that the US net bad debts have remained at around 1.86%. So this was around 1.84% back in February. So it looks like this has peaked. And Zip also announced a pretty strong guidance upgrade as well. So previously they expected that the second half of 26 would be broadly in line with the first half. And now they've upgraded that to have the full year cash EBITDA of 260 million, which implies a second half cash EBITDA of around 136 million, which is about a 10% increase on what they were forecasting back in February. So look, it's a really strong upgrade there. And as I spoke about at the start there, the net bad debts, they're guiding for less than 1.75% in the fourth quarter, which I think is what the market's kind of latched onto here. And we've seen the share price tick up pretty strongly off the back of this result, and it's up again today, which is really positive. They look like that they have peaked now, and management are really focused on making sure that they can be sustainable with their growth levels moving forward. So look, the turnaround is it was quick from February, and we can see that the market sentiment's changed on this one pretty quickly as we sort of expected it would. And as you can see on the chart here, so the share price has basically made back everything it had before that big drop back in February. So there was probably 2 or 3 months there where trading was a little bit weak, and we were able to pick up some shares in Zip pretty cheap, and you can see the upside that we've had over the past couple of weeks. Now, the other thing we wanted to discuss with you guys today is just the way that the technology sector is performing at the moment. So we've seen a pretty dramatic sell-off, and that's been driven by multiple things, which we've been discussing with you in detail. You've got rising bond yields and interest rates that have really affected the tech sector. We've had the AI scare, the SaaS apocalypse, as people are calling it, and we've also had the conflict in the Middle East adding further doubt for investors in growthy areas. But what we have seen over the past couple of weeks is that tech sector really bouncing pretty strongly. So it's up 17% over the past 13 trading days. And this is broadly in line with a bit of de-escalation in the Middle East, and we're seeing the bond yields come down a little bit now. So look, we think now is a pretty good time to be buying the tech sector, and that's what we've done. So we have reduced our cash weighting at the start of April, so a couple of weeks ago, as we saw a bit of a de-escalation in the Middle East. We added a basket of high-quality tech businesses: Car Group, Generation Development, Net Wealth, Pro Medicus, realestate.com, Xero, and Zip. And we also added to these positions towards the end of last week as we saw further momentum in the tech sector. So this is just how the stocks that we've purchased are performing over the last month. A lot of these names have been really, really weak over the past sort of 6 months, and we're now starting to see a bit of momentum in the names and a lot of buying coming through. So we think we're positioned pretty well now. We've added to these positions, and you can see that Zip's up 70% over the past month. We've seen Net Wealth, Pro Medicus, GDG, and Car all up over 10% over the past month, and REA and Xero both up pretty strongly as well. So we're building out our positions here. We spoke about that. We would be buying tech stocks at a point where we saw some de-escalation and saw some momentum building back into the tech sector. These stocks are all extremely well valued now. The valuation is super appealing, and the only thing we were waiting for was for sentiment to turn, and it looks like it might have here, which is exciting. So in summary, we've obviously been forced to be a little bit more active over the past 6 months with our direct positioning, and our asset allocation is what we potentially have been over the past few years, and that's been due to a variety of factors. Obviously, we spoke about a few of them before with the war and the AI SaaS apocalypse coming through. But what this has created is an opportunity to really up quality the portfolio, and we've been able to buy some extremely high quality businesses at really, really good valuations. So I think the portfolio is set up really, really well for the next 1 to 2 years, particularly in that direct equity space. And despite all the factors that are going on in the world with the war and the AI scares and interest rates, earnings growth for these quality businesses remains intact, and that's really what we're focused on. As always, this is general information. If you do require any further financial advice, please reach out to your licensed advisor. Thanks all for listening. We'll be in touch over the next couple of weeks with some more updates on how the portfolio is performing. Thanks, guys.